If you've ever heard someone say the market is up today, most of the time they're actually talking about the S&P 500, and understanding this one thing can completely change how you see investing. The S&P 500 is not a company, it's not a stock you can walk in and buy directly like you would buy shares of a business, and it's definitely not something complicated reserved only for Wall Street professionals. It's simply a list, but not just any list. It's a carefully selected group of 500 of the largest and most important companies in the United States. And together, these companies represent a massive portion of the entire U.S. economy. When people want to understand how the economy is doing, they don't go and check thousands of companies individually. They look at this index because it gives a clear, simple snapshot of overall market performance in one number. Now imagine you could take the biggest, most influential companies in America and put them into one basket. Companies like Apple Inc., Microsoft, Amazon, Nvidia, and Google are all part of this group. These are companies that millions of people use every single day, whether it's your smartphone, your computer, online shopping, or even cloud services running behind the scenes. Because these companies are so deeply connected to everyday life and business activity, tracking them together gives a very strong signal about what's happening in the real economy. When these companies grow, it usually means businesses are doing well, people are spending money, and innovation is moving forward. The S&P 500 is managed by an organization called S&P Dow Jones Indices, and they don't just randomly pick companies to include. There are strict rules. A company has to be large, financially stable, publicly traded in the United States, and have a strong track record. This means the index is constantly being updated to reflect the strongest players in the market. If a company becomes weak or no longer meets the criteria, it can be removed and replaced by a stronger one. This is one of the key reasons why the S&P 500 has performed so well over long periods of time. It automatically evolves with the economy, always keeping the most relevant companies inside. Another important thing to understand is that the S&P 500 is weighted by market capitalization. That sounds complicated, but it's actually simple. It just means bigger companies have a bigger impact on the index. For example, if Apple is worth more than a smaller company in the index, then Apple's stock movement will influence the index more. So if Apple goes up significantly, it can pull the entire index up with it. This weighting system makes the index more realistic because in the real world, larger companies do have more influence on the economy than smaller ones. It's not an equal system, and that's actually what makes it more accurate. Now here's where things get interesting. Even though you cannot directly buy the S&P 500 as a single stock, you can invest in it through something called index funds, or ETFs. These are investment tools that are designed to copy the performance of the index. Instead of picking individual stocks and trying to guess which one will go up, you simply invest in the entire basket. This approach is one of the most popular strategies used by long-term investors, including legends like Warren Buffett, who has repeatedly said that for most people, investing in an S&P 500 index fund is the smartest move they can make. The reason this works so well comes down to diversification. When you invest in a single stock, you are taking a risk on that one company. If it fails, you lose money. But when you invest in 500 companies at once, your risk is spread out. Some companies might go down, but others will go up. Over time, the overall trend has historically been upward because the U.S. economy continues to grow. This is why the S&P 500 is often considered one of the safest and most reliable ways to build wealth over the long term, especially for beginners who don't want to spend hours analyzing individual companies. Another powerful aspect of the S&P 500 is its historical performance. Over the past several decades, it has delivered average annual returns of around 8 to 10% when adjusted over long periods. That might not sound exciting at first, but when you combine that with compound growth, it becomes incredibly powerful. Money invested in the index doesn't just grow linearly, it grows exponentially over time. This is why people who start early and stay consistent often end up building significant wealth without needing to take extreme risks or make complicated decisions. At the same time, it's important to understand that the S&P 500 is not risk-free. The market goes up and down. There are years when it drops, sometimes sharply, especially during economic crises, recessions, or global uncertainty. But historically, every major drop has eventually been followed by a recovery and new highs. This pattern is what gives long-term investors confidence. Instead of trying to time the market perfectly, they stay invested and let time do the heavy lifting. This mindset is what separates successful investors from those who panic and make emotional decisions. So when someone says invest in the market, what they often really mean is investing in something like the S&P 500. It's simple, it's diversified, it's proven, and it reflects the strength of the U.S. economy as a whole. You're not betting on one company, you're betting on the continued growth of America's biggest and most successful businesses. And historically, that has been a very strong bet. When people see the S&P 500 going up or down, most assume it's just based on whether companies are doing well or not, but the reality is a bit more technical and much more interesting. The S&P 500 is calculated using something called market capitalization weighting, which means each company's influence on the index depends on its total value in the stock market. Larger companies have a bigger impact, while smaller companies have less influence. So, when a company like Apple Inc. or Microsoft moves even slightly, it can shift the entire index because of how large they are compared to other companies in the list. This is why sometimes the index might go up even if many smaller companies are down, simply because the biggest companies are performing well. Now here's where it gets even more important to understand. The S&P 500 doesn't just take the stock prices and average them out. Instead, it uses a formula that adjusts for market value, share availability, and other factors to create a more accurate representation of the market. This ensures that the index reflects real economic weight, not just price movements. For example, a company with a high stock price but a small overall value won't dominate the index, while a massive company with a slightly lower stock price but a huge valuation will have much more influence. This makes the index more realistic and aligned with how the actual economy works. Another key part of the S&P 500 is how companies get added or removed. It's not automatic and it's not purely based on size. The index is managed by S&P Dow Jones Indices, and they follow strict criteria before including a company. A company must be based in the United States, have a large market capitalization, be highly liquid, and show consistent financial performance. This means the index is constantly evolving. When a company becomes stronger and more important to the economy, it can be added. When a company declines or no longer meets the requirements, it can be removed. This process keeps the index fresh and focused on the most relevant companies at any given time. This dynamic nature is one of the biggest strengths of the S&P 500. You don't have to worry about picking which companies will succeed in the future because the index automatically adjusts over time. If a new industry starts growing rapidly, like technology or artificial intelligence, companies from that sector will naturally become a larger part of the index, and if older industries decline, their influence will shrink. This built-in evolution allows investors to stay aligned with the changing economy without needing to constantly manage their portfolio. Another factor that influences the S&P 500 is investor sentiment. This is more psychological than fundamental. Sometimes markets move not because of actual changes in the economy, but because of how investors feel about the future. Fear and uncertainty can cause sharp declines, while optimism and confidence can drive strong rallies. This emotional component is what creates volatility in the market, even when the underlying fundamentals haven't changed significantly. So when you see the S&P 500 going up or down, it's not just a random number moving on a screen. It's the result of millions of decisions made by investors reacting to economic data, corporate performance, global events, and future expectations. Understanding this helps you stay calm during volatility because you realize that short-term movements are part of a much larger system.